This week in 12 on the Markets, we look at the risks and the rewards of going global. Joining us today to take a closer look at investing in emerging markets is Jose Pedrera. Mr. Pedrera is a founding partner of LW Asset Management and portfolio manager of the Forum Absolute Return Fund that targets investing in distressed and emerging market debt and equity securities. Since 1999, the numbers there they are. The fund has posted an annualized return of just over 31% with nearly $400 million under management. Nice to have you on the program.
Thank you.
Yeah, for our individual investors at home, emerging markets, how do you define them?
It's emerging markets are economies that are growing, that have a potential for growing over the years, obviously with volatility associated with global imbalances and volatility associated with the political risk of the individual countries. But going forward, they're going to evolve in a bigger way. As
you look at the emerging markets that are out there as you're investing your hedge fund, what are the real strong emerging markets at this point?
The commodity-driven economies are the ones that are doing much better these days, obviously because of the demand by commodities by countries like China, for instance. China as a producer, it's been growing probably the largest at this point in time, with average of about 9% over the last 3 years, year on year. Then you have in Latin America following probably Brazil. It's another large economy that has been growing as a result of commodity prices. And then you have the oil countries, Russia, Venezuela, for instance, Mexico.
As you look at those countries you mentioned, though, and we were just talking a moment before the program, there was an article in the Wall Street Journal last week about Brazil and the red tape that many business people going in to do business there run into, court cases that last 20 years. You know, lack of transparency that exists. Should that concern an individual investor when they're choosing perhaps a fund to invest in, or a specific one that's allocated maybe specifically with one country, or
Absolutely.
Businesses in one country?
Absolutely. And the issue with the legislation and in some cases lack of transparency of legislation in some of these countries is important. We as professionals in the field, we look after that. Individual investors going directly by themselves into these countries got to be very careful with that.
Yeah, so what should an individual investor do? Because you really 30% annualized return is something that appeals to an individual investor, but I think, as you mentioned, very challenging to do on your own.
Well, I'm sorry.
Yeah, how would they go about this?
Obviously, experience is a key factor in these markets. We've been involved in these markets for the last 25 years. Combined experience among the people managing the portfolios and the risk management, it's over 60 years of experience in this market. As an individual investor going into this market, there are many factors that you have to look and probably get into the details of the specifics. Diversification is key as well. We diversify the portfolios among the regions, among the countries. We look for fundamentals. We look at the politics as well of the countries. There are many factors involved that an individual investor will have to look by itself would be very, very difficult.
How important is understanding currency? We look now at China and the yuan and pegging to the dollar and changing that to a more flexible currency. How important is that for an investor individual investor to understand that when they're going into one of these funds?
The currency risk could be huge. It could wipe out profits completely in these countries. What we do, we try to associate everything in hard currency, either dollars or euros. Most of the instruments that we effectively use to deploy our strategies are dollar denominated. Therefore, we eliminate the currency risk.
What would be red flags for an individual investor if they're looking for a portfolio manager, they're looking to do this, that perhaps that's not the fund to go with? What would be some of the problems they might get hints of?
Well, track record, it's at the end of the day one of the most important things. You got to look at the track record of the performance of the fund and the managers of a portfolio. Also important is to do background checks on the managers. Extremely important. One of the things that are happening and it's moving relatively quick. By the end of actually February of 2006, most of hedge fund managers had to be registered with the SEC. That's going to give an additional level of comfort and transparency to the industry itself.
And as you say, allocation of the portfolio, you're short, you're long, you very much have a diversified portfolio, which is, I guess, essential, especially with the volatility in these markets.
What we do, it's sort of unique, because we try to take advantage of the extremes of a market cycle. At the end of the day, it's a market cycle. I mean, we have the market boom and the market bust. We've seen it, going back to the 80s, 90s, and more recently with the Russian crisis, long-term capital debacle and whatnot. We try to concentrate on the extremes by going short what we believe is in the complacency stage of a market cycle, and by going long what we believe is in the panic stage where there is a lot of potential upside.
All right, Jose Pedrera, Southwestern Connecticut resident, we want to thank you so much for joining us.
Thank you.
All right, and that's all for this week. We'll see you next week on 12 on the Money. I'm Rebecca Saran.